Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, October 3rd, 2024. What I'm going to do in this one is just start out here with Intel because I just threw that one out to you guys this morning. I just wanted to highlight that right now as a bounce trading opportunity. Along it did some follow-ups after we hit that first target there. It was the high, 24.66. We reversed. And in the last couple updates, or at least the last one, I said any pullback to that 22 would be an objective long entry. So, in part of trading, it'll either pan out or not. I like it. I love it. In fact, took a pretty heavy position this morning. And the thing is that, you have to have these things marked if you like it, if you took it. Don't wait for the post to come out. Those things are labeled advanced. And look, it's not really taken off yet. So I just wanted to harp that. When you, mark these levels up, have price alerts set in case you're, again, if some of you do this full time, you're in front of the computer all day like me, you can see it. Otherwise, you can get a price alert, say, oh, it hit 22, which is the top of that basing pattern. I can go long. And then what I did on this one, you'll notice I gave you just two targets, two official targets. Potential means just that, potential. If it gets up there, I'll let you know my thoughts. That'll depend on how the charts of both Intel look at the time, the semiconductors, the stock market as a whole, volume patterns on this, everything. A lot will go into that. But as of now, these are your two final targets. You see the little bounce target there. So T1 would be a quick 5% or so pop, get in, get out, and that kind of thing. Maybe a little higher up here to about 20. I just kind of fired this off quick and wanted to give you two targets on the 60 that I didn't have before. And just say, at the very least, this is good for what I call a reflexive bounce. And I have a high degree of confidence it'll go there. So what that means, I just hit a heavy. Heavy is like a big full, heavy full position that I can take down at night because it is a stock. Unlike futures, I can set a stop and it gets, if the futures tank because, Iran, lobs a nuke that we didn't know they had over Israel. Then I'm going to be stopped out at 3 a.m, but not on Intel. It could be subject to a big gap down because it's a stock, it's an equity, and there's no liquidity, and it doesn't trade, other than stop limit orders, which are useless in my opinion in after-hour session because they can be bypassed. A stop limit order will fill at and only at the stop limit price. If stock gaps a penny below that price, it never executes, and the stock can keep falling, and your stop limit order did nothing. So in the daytime, you can use stop loss orders, and those are triggered once the price is hit. Then it becomes a market order, and even if the stock's water falling down, it'll still fill you. It might not fill you at your stop loss price, but at least you'll be filled. So I just throw that out there, and those are some of the pitfalls and things you need to be aware of when trading individual stocks. And again, it's one reason, among others, that I like futures with the liquidity, especially the index futures that are very liquid, all around the clock, and you can sleep. I sleep better at night with those. All right, so that's it. Hit hard. I'll probably just strip off a part of that big position. And I'm, like I said, I'm leaning to. I'll watch this closely. I'm going to watch volume, and what I do on trades like this, I told you I could easily see it carrying up more. As I get close to my target, I'll just start tight trailing up stops, ratchet them up. I like to manually ratchet, and that allows for a runner trade just in case it wants to keep going, wants to go past 23.11. All right, so that's that. T2 is our former T1, which again, you can see it on the daily chart. That's what we hit the other day. So boom, boom, boom. And if I think if the market holds up and market's going to new highs and things like that, there'll be the potential for this stock to come up a lot more. Even when it got knocked down here, if you recall, when I first put it on as a long trade idea, I said, if nothing else, Intel is probably going to be a potential takeover candidate or acquisition by private equity or another firm. And sure enough, that was the buzz on a lot of the news that did this for us. So, it wasn't a prophetic call. This is Intel. It used to be, the king of semis. And, when you can buy the stock, and they'll most likely figure things out. And I don't know if they're going to go anytime soon to their previous highs, but it's down 72%. So anyway, it was we'll see if it plays out again. Like I said, and that's what stops are for. If it doesn't play out, boom, stop out, move on to the next one. No big deal. All right, let's get off that one, and let's segue in since it's a semi. I'll give you an update on the SOXX. Intel, I would normally tell you I would view that as a hedge to a short on the semis, but not really, because Intel, as I've covered many times in the past, has just been almost completely uncorrelated to the semiconductor sector for years now, not just months. So I just want to say that, because you would normally think, for example, if you go, short the semi sector via SOXX or SOXX, the 3-time leverage short, and you buy, let's say, Taiwan Semi, NVDA, Broadcom, Micron, yeah, those are indirect hedges that will most likely offset. And I'm going to talk on that in a second with the stock market and treasury bonds here. But anywho, this is on its own merit, still looks good. Remember, this was a recent trade idea on the 60-minute chart here. We broke down, hit our first target as expected. We bounced, so far so good. And look where we bounced back to. There's a gap right here, gap resistance. You can see this gap right here I'm talking about. And so this is an objective short entry here, or re-entry if you took profits at T1, quick profits. So I just wanted to mention that. So there's SOXX, still liking that on the short side. That brings me over to NVDA. NVDA still into my shorting zone right now. That doesn't mean for me every time it goes in there, because you can't build a position. You keep build. I told you I shorted the bottom and the top of the zone, and I'll sit patiently and wait, and then add if and when I see a time to go all in on that, full short position, which will probably be a break of the recent lows. And then, of course, it depends on the rest of the semis too. But, if you're interested, it's an objective short here. Back still below the trend line after multiple rejections there. And nothing's changed on the longer-term technical posture. And that all-in moment for me still remains really pretty much that break of the primary. This is your primary bull market uptrend line from the October 2022 lows. And that should be lights out, especially when we've clearly given that. What does that mean? In a solid daily close, all the better if you see 2 or 3 red candles below it, or you close a week below it, because it's also a trend line, same trend line on the weekly chart. And these are the targets I gave you way back when here. And so far we've been, it's a, like I like to do, and I know this gets confused, I micromanage trend trades, if you will. Both on the stock market, but on NVIDIA. This is where I see NVIDIA going right now. My final official target's at 40. Shorted it back here. Shorted several times, but also covered here, went long, shorted again there, covered there, went long again. And so this is what I call micromanaging, and you almost have to do it unless you have just, balls of steel and you're willing to ride out, if you believe it's going to go that far, but you're willing to sit through a 45% counter trend bounce. I'm sorry, I'm not. And if I see a chance of even half of that or a third of that, I'm going to turn around, reverse, and game it. So that is, just to explain my constant flip-flopping on positioning. But I always try to make clear that, when I've changed my view, short-term or longer-term, and there's a massive difference, because it's not unusual for me to have the same security, whether it's a commodity, a stock, a bond, an index, and to be short in or long in my longer term non-active trading accounts that I have different brokers, can't possibly log into all these, and some of them just take forever to input and do quick trading. So on those, I'll sit and hold and ride out. And obviously not NVIDIA. I told you that day, August 5th, all accounts, but it was closing out all shorts and going full long. That's a major low right there. But then all the other little ones, not always. I'll start to scale back in a position. But then in my active trading account, long short. And again, I do my best to convey what kind of time frame trades are. Like this Intel here. That's what I started out with. I'm looking right now. Just a quick reflexive bounce, and I will most likely be out of all of that position before we even get up, if we even get up to T2 again. We'll see. I'll keep you posted, but again, I'm looking to get that quick bounce, get in, get out, and trail up some, most likely. But again, it depends on what else. That's why I do these long-winded videos. Let's go back to, so I covered NVIDIA, and then that segues into QQQ, the tech-heavy QQQ. Here's what it looks like on the 60-minute chart. You had a divergent high there, as I mentioned. We've been stair-stepping lower. And so for today, we have a reaction right here. You can see it better on the 15-minute chart. That gives us a nice downtrend line, which forms. So you have a couple things here. This was our primary uptrend line, gave us a bearish rising wedge pattern with negative divergence. This is a 15-minute chart, but it's the same thing I just showed you on the 60. Now I've just added this trend line today because we have a couple reaction lows here and that one little spike that I left out here. So this is how 1, 2, well, right there, perfect reaction low. And now you have this. So you have this symmetrical triangle pattern. My near to longer term outlook has not changed. It's bearish, so I expect a break to the downside, but I will respect a break of the upside. And again, nothing for swing positionings. I've been very consistent on this all along. Nothing changes until we really, this is that kind of, escape velocity area here. And let me give you the different board here. We have my market top zone from back in late June. And unless that's taken out in the comparable one on the S&P 500, I'm treating this as where the stock market's topping or has already topped in the case of QQQ. And, I'll adjust accordingly if proven wrong. So any rallies back into this area for swing or trend or long-term trades for these, these targets here, we've already hit the first two, covered it there because it just the bounce looked too certain and too big. That's it. So it's going to get back in time but not be married to anything. Like I said, this is where things start to change technically. And again, I told you before, I'll address it at the time. Yes, it'll almost certainly, if it happens soon, I can take these divergence lines, draw them like this. So if there was some pop tomorrow on the employment report that's coming out tomorrow, whatever happens, it wouldn't be a day or two, but within the next week or so, it'll still be a divergent high. And so at that point, I may be, if I've exited everything, I may be re-entering. If I decide to leave some on, I'll tell you. I always say that I'm not a completely rigid trader. I'm quite flexible. I do have a trading plan, but the trading plan is always subject to modification if the charts or whatever else I see, volume, one stock or sector is doing, a red flag in the bond market, something else, then that'll change. As of now, no change in my near or intermediate term outlook, which says we're going to do this. We've got an election coming up, which is let's just call it a chit show, CHIT. So in case young ones are out there, hopefully no young ones are listening to my voice, but it is a whatever. You think what you want of the two candidates. Obviously, my opinion on neither of those candidates is very high. More so, not that. I don't care. You don't have to like a candidate. I've voted for, most people don't vote for someone they like. They just vote for policies. But that's the thing about this one, the policies and the competency of these two and the agendas. Oh, God, I don't know. And then what's going on around the world. So this market, you got to give it props. There's just so much flipping liquidity that the Fed injected into the financial system since COVID, and it's still just what I view it as, guys. This is just, and I'm digressing, but when you look at the stock market, let me just look at that. Let me show you something here. Let me go to the comp, COMPQ, and let's just turn off all the lines, play around with this. Let's look at this monthly chart, NASDAQ composite, and let's, for kicks and giggles, park this over here. Here, let me just drag it down, give us a little real estate. So here's the NASDAQ composite. And I'm going to turn off log scaling and show you arithmetic scaling and just show you what this looks like. Here, I'll do it on the S&P because this NASDAQ was an extreme. So there's SPX. You can see, again, when log scaling, you're going to get these parabolic type moves, but it looks like it makes 1999 look like a walk in the park. Again, it's probably closer to the NASDAQ or the NASDAQ composite. You can see that run up here. If you can, I'll pull it back. You get this parabolic type top, and you have something similar now. And right there. So that's what the markets look like. Now I do use log scaling. It is more accurate to paint a picture because it adjusts price levels in proportionate or percentage terms. Even then, you still have just the making of what seems like just one massive blow off type top right there. But then the interesting part comes when you do put on the lines, because the lines to me are very important. That's what we do here. If this didn't work, I wouldn't be doing what I'm doing right now. I wouldn't be talking to you, and I wouldn't be trading for a living. We look at these lines here, and you can see that the stock market has things that we call secular trends or secular bull markets. And then, and this is really, to be honest with you, one large secular bull market. These smaller, or so-called, that was about a 78% drop, almost 80% in the NASDAQ 100, because it was chock full of .com, just like the AI hype now. Companies that were insanely overvalued in pricing and, 20 years of optimal growth potential that hadn't been yet recognized. But either way, you can see, so that's a cyclical bear market, cyclical bull market, cyclical bear market. It doesn't look like much, but it's a 55+% drop. That's a great recession right there. And then this is where it started here, the Fed gone wild. The Fed, in their infinite wisdom, has decided they were going to do their best, their damnedest, to abolish an age-old, condition in the markets called the business cycle. And that is, you have, just like the Earth spins around, rotates the sun, takes about a year to go around, but you get also, it tilts on its axis in between there. So I should be talking about the seasons as the Earth is tilting, and you get the summer, winter, fall, spring, right? That's the Earth tilting there. And so when we have our winter up north in the northern hemisphere, they're having summer down the southern hemisphere and vice versa. And so it's natural. And if, let's just say you had a giant, big enough hand to just grab the Earth and stop it from rotating, you're going to screw things up for a while there. And let's say you want to, let's say you had the power to do it, like the Fed. You're going to stop that plan. You're going to put it right maybe on spring, late spring, early summer. You have that perfect weather. The birds are always singing. The flowers are blooming, and all that good stuff. Right. Leave it there. It's going to be beautiful for a while. But what's going to happen? The Earth will die, obviously, because they're not pollinating the friggin' flowers down in South America at the same time and in the southern hemisphere. And you've got permafrost forming in other areas that aren't used to it. You have other areas that should be thawing out. There are permafrost on the other side there. So you get what I'm saying. And that's what the Fed's done here. And it happened back here. This is where they started the grand experiment. And they figured, oh my God, all we have to do every time there's a recession or the market starts to wobble, and that was a real one. They had to come in and do something. The whole financial system was collapsing because they, of course, created it with the debt bubble and uber low rates. And then they just figured every time we get a little something, and then COVID hit, and they just went just all out like crazy. Like, okay, it doesn't matter anymore. Milton Friedman was wrong. We can just print as much money as we want because the U.S. we're immune to inflation. And then they realize, oh gosh, maybe economics 101 is true. Print enough money, you're going to get inflation. And so then we know what happens. So now we're kind of getting this volatility period. But again, we'll look at the charts. I'll just sit there and ramble on what I'm talking right now, or what I was just talking about is fundamental analysis. But this is technical analysis. This tells me here's your current uptrend line on the NASDAQ composite right there. It's very well defined off the lows. You have the biggest divergence, negative divergence that we've had since, in fact, the last time we had negative divergence right here was our divergence line right there. And the NASDAQ composite fell. I'm going to try to grab at the top point. 36%. Before there, you had it right there. I know the S&P fell 36 also. You had it there. So you can see, these divergences, they work. And if I'm missing any, let me know. But that was a divergent high. That was a divergent high. And these were all the corrections, technically if you use the old school 10% or more drop, or 20% or more, it was a bear market, right? And okay, the only time you didn't have a divergent high, actually, I take that back. You actually did here on the RSI. You did have negative divergence, just not the PPO right there. and that was that big drop there. So, all right, what do we need to do to say that we're in a bear market? Right now, we're in a bull trend. We need to take out that trend line, and this is a monthly chart, so you have a high probability sell signal if you close the month below it, and then also that little blue line there, you can see that's the 20-month exponential moving average, and you'll say, "Oh, Randy, we've gone through it quite a bit." No, not really. Most of the time, they're either just a brief close, or you dip below it intramonth. Even COVID, right there, you closed a hair below it on February, and then in March, I think it was March, you had that reversal. It was a 6-week, because the Fed didn't allow it. It's what I call Ursa interruptus, my made-up term for a bear market, interrupted and prevented by the Fed. And that's it. So you close back above it. And then we did have a bear market here. Everyone agrees that was a bear market, right? We were below the 20 months. And same thing on the S&P 500. It's just a nice line to watch. So those are the things we watch. And then, of course, trend lines and all that. So right now, primary uptrend bullish, very near term. That's where I started the video. We dropped down to QQQ, SPY. We've got the 15-minute chart. Very near term. This is our trend right there. We're zigzagging lower. Break of this uptrend line will trigger the next objective short entry or sell signal. Likewise, an upside break of the downtrend line would be near-term bullish, especially if we take out that previous high and then that previous high, right? And that's just the 15-minute chart. That doesn't put us at new highs yet, but it does increase the odds we're going to run back at it. So there's the levels to watch, pretty clear. There's the way I think it's going to go. And let me cover a few more things, and we will wrap this up. All right, so the stock market's the stock market. Treasury bonds. Right now you have the biggest leg the bulls have to stand on to make the bullish case that we're not going to go into a recession anytime soon in the foreseeable future would be the resilient job market. We'll get the key jobs report will come out tomorrow. But there's kind of a not a catch-22, but just a trade to be made. So I'll give you guys, we're still short treasury bonds. We had the entry was right there on the break of that trend line. We put in, as talked about, a marginal but still divergent high. Sometimes you break down, you don't look back. You always zigzag, but sometimes you have a little snapback rally. And that one, like I said, only extended the negative divergence that was already in place. We hit our first target. We bounced. It was resistance right after we hit it. This is perfect technical analysis. That was T1 right here, 99.20. We gapped down below it. Boom, 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 boom. Rejected. Recently rejected. That was an objective short re-enter add-on. We had a bullish falling wedge, as I highlighted here. Recently on the 60-minute chart, that was a catalyst for that rally. But this is kind of a tell for me. Usually in a bull trend, when you get a 60-minute bullish falling wedge, that's a catalyst to new highs. And so far they bought it as I expected them to buy it. And of course, we hit a support right there. But what they did is the rally was pretty limited and got sold into. Now we do have, I'm going to show you right now, we still have a divergent low. The divergence has grown even larger. But the nature of a downtrend, especially early on, is you've got to recognize, if you believe, if you're bullish on treasuries and you see this, recognize it, you can go long, although we're in no man's land. We're not at support. So divergence is not a buy signal. But, this should play out. If it doesn't play out, then it tells me we may be in the earlier stages of a much deeper downtrend, right? That's a kind of a signature move for a bear trend. And remember, if you look at the divergence too, this divergent high right here was much larger. This is our big divergence leading up to that. This is small divergence. You usually get that on the early stage. So I'd like to see that burned through with lower lows in the indicators, what I'm getting at there. And the fact that we've taken out this 97.50 support level should open the door for a move down to T2. Also, guys, where I was going with the whole hedge thing, if you are, assuming you're short the market, and I think it makes sense to be short treasury bonds. Why? It's almost and it's what I call an indirect hedge. Again, indirect hedges are my favorite. I've said this many times. I don't do direct hedges. A direct hedge is if you're short QQQ, you buy calls on QQQ. That profits if QQQ goes up. Reason I don't do that, it's a one-to-one offset, and the only person making money is your broker because they're generating commissions on both trades, right? So if I don't have enough confidence to be in something, I'll just get out, right? Or set a tight stop in case it goes against me, and that way I'm out. That's usually what I'll do. An indirect hedge now, and we've done this often, and most of them have played out. I don't always point them out. It's not always an indirect hedge to go long or short treasuries against a position in the stock market. But right now, I see it as such fundamentally because let's just say the jobs numbers come in strong tomorrow, right? Really hot, above expectations, saying, oh, U.S. job market bears are wrong, it's resilient. Okay. What that's going to do, it's going to take the 50 basis point odds of the 50 basis point cut at the next meeting and knock him down, right? I think that's pretty clear. Meaning you can expect the Fed's not going to have as much ammunition to cut. It's going to show the economy is stronger, a little hotter than expected. At least that's the initial take. That should be the takeaway. And that should bring down longer term interest rates. Should bring down interest rates. Cause interest rates to go up, guys. Bonds and interest rates move opposite. So again, on a strong jobs report tomorrow, you'd expect this to fall further and probably hit T2 or maybe even T3, right? But that would also be the stock market's likely to rally because, hey, everything's really good. We've got the Fed. They already gave us 50. Okay, maybe we won't get another 50 at the next meeting, but we're going to get, they already said he'd give it to us another quarter point. And so the market would like that. So therefore, you'd profit on your short, if that happens, on treasuries. And that should help offset any rally in equities at the same time. And remember, this is a 2-time plus beta adjusted position size. So treasury bonds don't move up and down as much as the stock market. So I usually suggest or personally take a 2+ time position size on treasuries. Compared to the stock market trade, SPY. That's when I talk about beta adjusting. If you're new to the site, let me show you. Okay, when you see these, that's a link. When I italicize it and then you have the dotted line under there, that's just that's a hyperlink that'll bring you back to the last post. But when you see these, just the non-italics, but the little dotted lines below, these are called tooltips. And if you just hover, so T1 means first price target, T2 means second. You can see the pop-up. Beta adjusted position size. That's a term I made up for reducing or increasing above your typical position size based on the expected volatility of the trade. Visit the FAQ page for more detailed explanations. So you can go to resources up here on the top corner, FAQs, trading related questions when you get there, and what is beta adjusted position sizing. So way back over a decade ago, I made the term up before that, but then this is how, what it means and, how you can come up with it on your own as well. You can look at things like the average true range. So you can take a look at that. Okay, and that's it. So at this point in time, because of the reasons I mentioned, again, any positive or economic data that comes out should support the case for higher yields. I think fundamentally, the case for higher yields longer term is there because both candidates, no matter who we get, they're going to blow the budget up. And again, it just keeps increasing. There's no talk of fiscal discipline here. There's these vague, just crazy, tax or estimates on what they're going to do to the budget, and then what kind of incomes are going to offset that and all that via economic growth or taxation. I'll just tell you guys be prepared. If you're an earner, be prepared to start writing some big fat checks going forward. Anywhere you can kind of minimize your taxable income shift. Maybe at some point I'll start, if I get enough interest, we'll look at things like that. There's not a whole lot I can't advise you on how to control your income. There's different ways. Talk to your accountant on that. As far as the financial markets go, a couple quick tips. Muni bonds are obviously one. I could talk for hours if you want to made to do a little video or side thing on that. I'll talk about it. I used to be a financial advisor. One thing I would tell you, if you can buy individual muni bonds versus a bond fund, you're better off. Individual bonds are guaranteed to pay off at maturity, as long as, again, with the municipal market, there's little nuances. Got to look at your issuer. Is it a geo bond? Is it a revenue bond? Is it insured? All that other stuff. So be careful if you don't know what you're doing in the muni bond world. But bond funds generally stay away from in a rising interest rate environment. You're going to lose money. In most cases, you're going to offset any income you earn. Other benefits for ways, obviously capital gains. They're going to probably fudge around what they do with tax capital gains treatment. But then there's futures, which I love. 60-40 taxation, long-term versus short-term gains, no matter what your holding period is. That's another big reason I trade futures. So I'm digressing, but I just wanted to say, in the coming years, you can shift money, convert into, traditional IRAs, or if you had a 401k you rolled over, maybe convert that into a Roth sooner than later, because down the pike, we're going to see, I believe, some pretty big increases in income tax rates. All right, enough digression. Let's get to the last two, and we'll just wrap up. So, the common theme is lately, and I usually harp on it, diversify. Whether it's investing long-term or trading. This is UNG, our UNG trade right here. Continues to walk up. As I said, she, in my opinion, kind of hit that escape velocity here. When it broke out of the big trading range that we've been monitoring for quite a while. We've been going long here on these divergent lows at the bottom, broke out, back tested. This is like Intel, right? Breakout back test, although similar, hasn't run up a notch yet. And I keep pointing out we have negative divergences. I would be remiss to not point those out. But as I said, natural gas, when it really wants to run, if it has reached escape velocity, it's not ripping yet. This is a rip. This is a unidirectional rip where it's just hammered down up. And then in reverse, you get these hammered down. They just don't let the shorts or the longs out in these drops, or the shorts in. So we're not in that mode yet. And it could happen or it may not. All I can tell you is these are the levels that I can tell you to watch right now. You've got a minor uptrend right there that forms a bearish rising wedge. Rates down, as I've been highlighting, this would be an objective long entry or re-entry, as would a pullback to the top of the range. Anything much below that, I would at least hold off. I wouldn't be adding to longs if it falls back in the range. I might give it a little room to not get shaken out of the stops. That's your objective re-entry point. If we do break down, if this wedge plays out, add two, but not below 1525 right there. And then at that point, you would want to have, again, if you're playing the long game, looking for these longer term targets, have your stops probably staggered is what I usually like to do. Not a single stop to take me out of everything, but partial. Meaning in partial lots, 1/3, 1/3, 1/3, wherever that is. But right now, looking good. I just want to say that. And natural gas, when she wants to run, she can burn through divergences like they're not even there. So as of now, still looking good and very profitable. Remember, the futures are up even more, but the ETN here, which unfortunately does its best, but has expenses and fees to roll and track the natural gas futures, it's up 32% off those lows recently. We're probably well north of 40, 45, maybe even 50% on the futures. But those roll every month. I have to keep updating the charts. And if you want those, let me know. I'll give you an updated chart. All right, next up. And then wheat, corn, all that. I just updated that yesterday. No reason to do much of an update. We're still holding above T2. And, I think if we can continue on up, there'll be corrections along the way. In fact, I need to point out, just like there, I pointed out we had a divergent high there. We also have one now. It's even bigger. We got a correction there. So this is what happens. So divergences in a bull trend, they'll play out for correction, but they're not taking us. This divergent high hasn't taken us to new lows like this one did. All right, so it's an early makings of an uptrend. This one could take us down here. This is really, it's comparable. That's the basing pattern right here. So any move back to, but not much below this level here, would be objective add-ons or re-entries. If you are trading wheat, and especially if you're trading the long game for the longer term targets. And I may add additional targets if we get up to T7. This is just my 60-minute chart. When I get to the daily chart, there's a whole lot more potential, I think, if we can, if the charts if they continue to firm up and if they continue to look constructive. And then on that too, the stocks I gave you yesterday, if you see the agricultural commodities continue to rise, that's when the rest of these period will break out. A lot of them I showed you yesterday is setups, poised to break out. Again, I did a video on this yesterday. Some have recently broken out, and quite a few are poised currently to break out, like Mosaic needs to take out the downtrend line, FMC needs to take out that 67.90, and so forth. ICL needs to take out the downtrend line. So like I said, some have already broken out, but again, you can watch that video. No reason to recap what I just covered yesterday. That's it. That's all I wanted to cover in this one. I don't want it to be super long. Get it out to you. So Intel still hasn't left the gate yet. If you're interested, it's still on that right off that $22-ish support right there. And so still offering an objective long. The stop I had hand drawn in there somewhere right below, I think below 20, a little below 2150 is what I was looking at. All right, let me wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.